if you already have your money on chain and you don't want to off ramp, which is, I mean, very good reasons why you wouldn't want to off ramp if you made your money in crypto, or you have a significant amount of your money on chain, you're completely constrained to just being able to invest in or trade crypto assets. And we had a pretty strong conviction that there would be this sort of like tailwind or like rising set of people who had a majority or a large portion of their wealth on chain and would want to get exposure to other assets.
Welcome to the Edge Podcast. I'm DeFi Dad here with Nomadic. Today's show features the co-founder and CEO of Ostium.
Thanks for having me on, guys. Excited for this.
Cal, thank you officially for joining us on the podcast. We want to first talk about your background. One part of that story that's just fascinating is you were a professional ballerina. I was mentioning before the podcast, just at one point in my life, long time ago, I wanted to be a professional baseball player. So I think when I first met you, maybe a year and a half ago, 2 years ago, I was like, whoa, that's really cool. So you got to tell us the story behind that.
Man, where do I start? I mean, I started dancing when I was 3. I think not many people, I think, can say they're lucky enough to have been able to achieve a childhood dream. So got the opportunity to do that. You know, when you start at 3, you're basically training for something that's like 15 plus years down the road because you can't really start dancing professionally until you're about 18, 19. I danced professionally for 5 years. After high school, I spent a year at Boston Ballet in Boston, and then I spent 4 years at the Royal Danish Ballet in Copenhagen, Denmark. I mean, I don't know. I maybe you're curious about sort of the day-to-day or what it's like. I mean, obviously it's a full-time, I think maybe there's some understanding sometimes, like it's a full-time kind of like Olympic athlete level job. It's a very unique, ballet is very unique because it marries the like discipline and physical intensity of an Olympic sport with the, I think, like sensitivity and artistic excellence of a classical art. It is very structured, but I think what it teaches you is that there's freedom to be found in that sort of structure. Like there's a very specific way that moves are supposed to be done. Like you carry your arms this very particular way, like everything down to like, you know, the way that you like hold your, you know, like middle finger relative to your like thumb is like crafted. And like, you know, you spend like probably spend hundreds of hours thinking about like the exact way that I hold my hand in my life. And like that's just one tiny piece. So it is highly meticulous, highly detail oriented. And yet it has you have to develop this kind of like intuitiveness and like in touch with the kind of immaterial that I think any sort of artist develops. So it's this very interesting marriage of like maybe kind of the ballet trilemma to analogize it to a blockchain would be like the like, you know, athletic intensity, the like artistic, like classical art specificity and meticulousness, and the like intuitive kind of like mysticism of like of art. And so I think maybe to translate that into like where my life has gone now, which is very, very different. And I retired from ballet basically with the assumption that I was starting my life from scratch, that like basically nothing that I had learned to date would be useful in a concrete sense. And I think that's been largely true. I mean, I just wonder like how much of my brain is just like busy storing like just like dozens of hours worth of choreography that I'm like never going to use again. There's like some part of my brain, like I hear some music and I still know like all the steps for, you know, like every part in the Nutcracker, like every part in Swan Lake. So there's a lot of, you know, data stored back there and like my permanent memory that is like probably never going to be useful again in my life. So that was a reasonably fair assumption, but I do think some of the principles that you learn and like the way that you learn how to work has been surprisingly translatable in ways I couldn't have anticipated. I'd point to a few. I think the obvious one is discipline. People generally are aware, you know, doing an Olympic level sport combined with classical art, it's going to require a lot of discipline. You know, you start, again, as I said, it started at like 3. Things really take off and I think get serious when you're like 6 or 7. And you got to do the same steps, like practice them every day. You have pretty tough teachers. Maybe it takes me to a second point, which is like thick skin. You develop really thick skin as a dancer. Like you got these Russian teachers, these like Soviet teachers who are from a different era. They have They are not subject, let's say, to the modern fluff and the, a trophy for everyone modern approach. Very, very, very tough people. Like I have some crazy stories. It's mostly like Russians and French people. They're like kind of the two big countries that I think have the most intense dance culture. And so you're raised around these kind of two very intense types of people who are very exacting and they do not dole out compliments easily. So you get a lot of tough pushback at a very young age. You develop very thick skin. I mean, you don't get selected for parts, or someone's really mean to you in class, or you're trying. So, I mean, I can't tell you how many times, like, some girl or whatever is like breaks down in the middle of ballet class, and you just like pick yourself up again and get back on stage. Or injuries too. I mean, the number of times I've like, me or any other dancer gets like maybe injured like mid show and just has to go back out on stage. You have to push through the pain. Very common. So very thick skin, both in terms of like ability to sustain physical pain and some level of like emotional toughness. And then probably the last thing is multi-year time scale. I think when you start dancing at 3, you have a dream that I mean, you're not delusional. Like even when you're 3 or 4, you know that if you keep going down this road, it's not going to be something that'll bear fruit for another like 15 years. We live in a world of instant gratification, of expected instant results. I think unfortunately this has been one of the things that's plagued crypto generally, is there's such a quick like flip that people expect. I think this concept of like company building that is, or has, I think traditionally like used to be more common. Even, and I'm not even talking like normal Web 2 startup culture. I'm talking like people used to start family businesses and like keep them around for generations. We've generally, I think, lost the art. I mean, people used to build cathedrals for hundreds of years. Like we've lost the art of like building stuff over many decades or hundreds of years. And I think that's been like been a general trend, and it's only accelerated in the last like 10 years. So I think it's a superpower to be able to think on. I mean, obviously I'm not, I hear Ballet's not a cathedral. Your career as a dancer is, maximum a couple decades. So you're not operating on like a family business multi-100-year timescale, but you are operating over like you start very young with a vision towards realizing something that won't be true for at least 15 years, which gives you this ability to think on long time scales from a very young age and delay gratification. It's like the most extreme version of the marshmallow test for kids. And I think that is a superpower if harnessed correctly for your other phases of life. So yeah, those are kind of my big lessons and reflections.
Before we go any further, let's hear a quick word from our sponsors who make the Edge podcast possible. Sponsors like REDSTONE and TOROS Finance. Grow wealth exponentially. With TOROS leveraged tokens, when the market moves in your favor, your gains become parabolic. They're built to ride trends, auto-compounding profits. With TOROS, it's simple. Pick a vault, deposit, and your exposure is multiplied, maintained, and protected automatically against liquidations. TOROS reduces risk and keeps you in the market, ready for the rebound. When markets dip, the vaults auto-adjust, softening losses and preserving your position. Just pick a token to multiply your returns. TOROS Finance, exponential gains with leveraged tokens. To learn more, go to toros.finance. REDSTONE is building the Oracle backbone to unlock real-world finance on-chain and next-gen DeFi. With modular gas-efficient feeds across over 110 chains, trusted by 170 clients, supporting over 1,300 assets, from value-accruing stablecoins, liquid staking and restaking tokens, to treasuries, private credit, and commodity tokens, REDSTONE delivers accurate real-time data where it matters most. The biggest platforms and protocols in DeFi today choose REDSTONE oracles, such as Athena, Securitize, BlackRock Biddle, Pendle, Spark, and Maple Finance. If you're building the future of finance on-chain, you need REDSTONE's leading modular blockchain oracle layer. To learn more, go to redstone.finance, and thanks to REDSTONE for supporting us here at the Edge Podcast and Edge Newsletter. Banks use your money to line the pockets of shareholders. Meanwhile, Solstice uses the same yield strategies to line your pockets. Introducing Yield Vault, Solana's best yield. A live delta neutral strategy with positive returns month over month for 3 years. Built for internet capital markets and powered by the stablecoin USX. To learn more, go to solstice.finance. Neutral is the next generation of crypto-native yield. Their synthetic dollar NUSD taps into OTC arbitrage, funding rate inefficiencies, and delta-neutral strategies to deliver premium, stable returns without taking market direction risk. Neutral is now officially live to mint NUSD and start earning neutral points. Learn more at neutral.fi.
No, but I think what you said, there's so many important lessons that you can clearly take from that background. Like you talked about physical pain, emotional toughness, long time scale, delayed gratification. These are like all things we've had to come to endure and experience as crypto investors. I mean, probably the most prominent one is physical pain. I think a lot of us have been feeling a lot of that lately. But okay, I want to just take this a little bit further into, okay, how do you get into what you've got into now?
Yeah, it's a great question. So I'd always been interested in markets. I've mentioned this before a couple of times, but I had very libertarian parents that gave me a Thomas Sowell book when I was like 12. That I was like the weird girl at the ballet summer camp who would like sit in the dining hall rather than like playing with the other kids. I'd like read my Sowell like basic economics book. So always been deeply a nerd, and I say that like that's the best thing ever. So I generally like my interest had always been in markets, and economics, incentives. I was at a very vague notion of all this when I was in high school, but directionally, I think that was sort of like the arc that I was trending. So when I decided to retire and go back to school, I wound up studying neuroscience. Actually, I had this kind of fork in the road between going down the science route or going down more of like a markets route. I ultimately opted for certainly what was the right choice, which was going down more the markets direction, which is sort of where my interest had always been as a kid and for most of my life. And then I spent a lot of my other classes that were not neuro or science related doing, econ, stats, markets, adjacent things. And then my summers I spent one working at a small cap value hedge fund, doing equities research, and then another one working at Bridgewater, again, just as an intern, but working for the CIO, looking at supply chain disruptions. It was 2021, so it was inflation summer, or beginning of inflation summer, when everyone was claiming it was very transitory, and it in fact wasn't. So that's my college time. To get into like, okay, how did I translate all of that? I did neuro, I was interested in like performance, high performance stuff, markets generally, like how did all these pieces come together? How did I get into crypto? So on the, market side, I worked for these, couple hedge funds, and I had my experience sort of in the corporate world. I quickly realized the corporate world was not for me. I was meant to do something on my own. I also realized the lab was not for me as much as I enjoyed science and sort of the intellectual component of it. Killing, mice all day and maintaining your bacterial cultures was not, I had some intuition. This was probably like not the best use of my skills. And so I knew I wanted to do something more, obviously like focused on markets. I knew sort of corporate world was not for me. I've always had a strong desire and intuition for like deep levels of ownership, like owning my own destiny and betting on myself. And then concurrently, and probably the most important piece, is I met Marco. And Marco's my co-founder. He's our CTO. I met him the first week of freshman fall in an intro econ class at EC10. It's like a 500-person class. And I often say we were maybe the two most engaged people in that class. We're constantly raising our hands. Eventually figured we should like probably talk to each other, not bother the rest of the class. And somewhere along that way, we found crypto. Like initially just from reading, we started out kind of like more high level on the intellectual side, like reading white papers, looking at mechanism design, going back to sort of this core theme of like market structure and understanding how markets and incentives work. And we always found it very fascinating that I think Burko has some funny quote that's like, in crypto, everybody gets to be their own Jerome Powell. Like you get to kind of like design your like money supply and your incentives and how you toggle them. And we found that very, very interesting, rather than sort of playing in like someone else's game. You can kind of design your own game and your own incentive set, and you can tweak all these different parameters and see how that affects behavior within a protocol. That was sort of the first maybe rabbit hole we went down. And then going from a first principles perspective, we were like, all right, we want to build something together. We want to build something in crypto. We want to build something that is sort of, involves a sort of like mechanism and incentive design. And concurrently, we had started trading together, just from our own PAs, and found a problem that we thought maybe we could solve. And that problem was twofold. One problem we saw was in crypto, which was there was no way to use your on-chain capital to go and trade things that were not crypto. It felt like everything that had been built to date was kind of prelude to what would ultimately be a much bigger market, in the sense that like all of the new market and incentive design was geared towards allowing people to transact trading crypto itself, which is, great. But the ultimate end goal, like if this technology is going to be extremely valuable, the ultimate end goal is enabling people to trade the like trillions of dollars worth of existing assets that are out there that should move onto blockchain rails. So we thought, one, that's going to be the biggest market. That's like the single biggest opportunity in crypto is enabling these rails to get people to trade stuff that's not like crypto assets themselves. And secondly, if you already have your money on chain and you don't want to off ramp, which is, very good reasons why you wouldn't want to off ramp if you made your money in crypto, or you have a significant amount of your money on chain, you're completely constrained to just being able to invest in or trade crypto assets. And we had a pretty strong conviction that there would be this sort of like tailwind or like rising set of people who had a majority or a large portion of their wealth on chain and would want to get exposure to other assets. We initially were very focused on like commodities specifically. We had this like strong conviction there'd be a commodity super cycle that's like wound up being very true, but we extended beyond like, I think an unnecessary focus on a single asset class to FX, indices, single name stocks, and all of these very liquid global markets that ultimately there was no really easy way to access on chain. So that's sort of the first problem. We thought like in the next couple of years, this market's going to exist and we can build to capture that market. The second, and I think more important, ultimately far larger TAM that we saw and problem that we wanted to solve, and this is one that we've been somewhat quiet on to date and have recently, I think, unveiled this larger plan as part of our recent fundraise, like Series A announcement, is a problem that we saw globally in what's called the CFD market. And for the uninitiated, CFDs they're contracts for difference or contract for differences. People put the S in different places. And they are the little known fact among crypto people, but they are the dominant retail derivative in the world. Larger than options. I don't know how American this audience is, but options are obviously huge for US and for Indian retail. But in every other market, and in every market, by the way, where both options and CFDs or perps are offered, I'm going to go over the sort of similarities between CFDs and perps, the latter always is the larger market because it's simpler. It's just a simpler instrument. Like options are, say like in crypto, given the option between options and perps, like people pick perps because they're just like an easier to understand instrument. And CFDs, similarly, that's the case. What are they? Synthetic instrument, easily long or short, can't redeem for the underlying, basically like linear exposure to the price change of the asset. Very similar, probably everything else, they don't expire, so very similar to a perp in many ways. The big difference is that perps have this sort of organic market mechanism where they have like a funding rate, for instance, or there's different like but funding rate, this like floating mark versus index price, and they are sort of these like exchange traded instruments. But from a like end user perspective, they're quite similar. And so the crazy thing is this market, these like CFDs are offered through this network of like fragmented offshore brokers. So these are, I don't know if I'm like allowed to name companies, but these are companies like eToro or like Plus 500, IG. There are many of them. It's not like a monopoly or duopoly or oligopoly. It's actually like pretty fragmented across a like large network of these brokers. And the insane thing is that for most people around the world, if they want to access the most liquid global markets, be that US equities or, large commodity markets, they have to go through one of these brokers. And what is the problem with these brokers? Like, why did we see a market opportunity here? Like, why is there something worth disrupting? The answer is that they're highly centralized. They're a complete black box. You have no idea what because they're not an exchange, right? They're a broker. They're not making their own markets. They're sourcing liquidity and quoting from those other markets. So you don't see an order book, which fine, but you also don't see, because it's not an exchange, but you also don't see what any of the trades are that anyone else is doing. You have no idea what the exposures are at any given moment in time that broker has. You have no idea what any other traders are doing in the platform. None of that is transparent. There's no order book. There's no nothing. And most importantly, they have full discretion over your funds. And maybe that's okay in like a highly regulated market where you like really trust the like, you know, broker or something. In the US has highly functional financial markets, which is interestingly why like I don't think the biggest opportunity in crypto is not in marginal improvements to like the US financial system. Like it's like pretty, maybe crypto bros won't want to hear me say this, but like it's a pretty damn functional system. Like the really big opportunity, and you see this with stablecoins, is in these markets that don't have developed financial markets, where they either, in the case of stablecoins, have to go through they got to save in a currency that does not, like, that inflates away. And so they're desperately looking for an alternative, which stablecoins provide, or they have no access to, US and other liquid global markets, and they have to go through one of these shady offshore brokers. And the problem is that these brokers will, one, they have no idea what's going on under the hood, and two, they have in many cases, let's say there are many reported instances of accounts being closed when traders become unexpectedly profitable because they take the other side to people's trades. And not only do they have a vested interest in tipping the scales in their own favor, they also have the ability to do so. And so I see this as kind of like my big picture vision here is kind of like the next evolution of like the next step after stablecoins. I think if you look at the kind of like broader global market and like what is not working for people, the first thing is they're like stuck in these currencies. They have these they're like these capital controls. They're stuck in these currencies that are devaluing, that they like don't want to save in. They desperately want access to a more stable currency, the dollar, and then stable coins by proxy provide that. And secondly, they want to trade, or they want market access to really liquid or high quality assets, like liquid global markets and high quality assets. And they don't have a good way of doing that besides going through one of these shady brokers. And so our broader vision, we still have this sort of jumping off point in our initial vision was to provide this exposure to these traditional assets to crypto traders. And I can go more into that and like where the product is today and how we've like found PMF in that audience. But the really big vision here is to ultimately disrupt what we think is a highly legacy market, which is this offshore broker market, with a fundamentally better instrument, so through a perp, and through a fundamentally completely different tech stack built on chain, where trades are transparent, you know exactly what's going on. Amazingly, like you wouldn't believe this, but like on those brokers, you don't even know, often they won't even show you a portfolio page. Like they won't even tell you how much money you've made or lost. You can't even track your own volume. Things that are considered table stakes in crypto about the level of transparency is like unheard of in this market. So we think there's a massive market opportunity in disrupting this super legacy market with a fundamentally better instrument and better infrastructure platform through building this on chain. So basically traditional market perpetuals. That was a very long roundabout answer, but I think hopefully covered that question and many others.
So I think we've gotten a lot of the detail behind why you're building Ostium, but let's give an overview. Can you walk us through the platform Ostium? What do you offer today to us as users in case someone is totally new to Ostium?
Sure. So I'll just start with sort of the super high level. Ostium today is a trading platform where you can get exposure to the most liquid global markets with the best execution and liquidity on chain. So we allow you to long or short assets like, NASDAQ, gold, oil, palladium, Tesla, you name it. How it works. So we actually allow you to log in directly from a wallet. You can also do a social sign-in through Privy, but you can just connect a wallet directly. You don't have to deposit into a separate account. So you can use the wallet that you have today on Arbitrum and the USDC you have on Arbitrum, which we think is better from a decentralization perspective as well. So keep that money in your wallet. You can open positions. Currently, positions are isolated margin. We're working towards a cross-margin feature, but today they're isolated margin, so individual positions. You can go long or short. You pick your asset across any of those asset classes, and then you can track all of that. Pretty straightforward. that's how the platform works today. A lot of features that we're working on adding in. There's a product on top of the core product that we launched sometime last year that we're in the process of revamping after a lot of customer requests, called Strategies, which allows you to leverage polymarket odds as a trigger for trades. So you could think of this as sort of a conditional order. A limit order is an order that's conditional on a price being hit. Like a little bit oversimplifying here, but like a TWAP is kind of like orders that are triggered by some timestamp, some time having passed. You can think of this as like event-based orders. So orders that are triggered based on some events. So you can think of like a canonical example would be like, if the probability of Trump winning the election is like higher than 80% long Bitcoin. And then you can extend that to all sorts of other world events that might be, have downstream impacts on other assets. So that's something we're working on revamping. You can see it on the strategies page. It's currently, the current version is sunsetted. And that sort of is part of this like broader vision to service trading global markets and macro all in one place. So tracking events, what's going to happen in the world, and then translate that into views on these like broader global markets. That's the product today.
Cal, maybe for people listening to this, can you just walk through what type of leverage people can get? Like for example, one that I have up right now is just, you can trade up to 100x leverage on Apple stock, which is like insane to me. But can you give us just a few other examples of maybe, this is like currencies, commodities, equities, and what's like the leverage kind of ranges that people can use here?
The MANTLE Global Hackathon is a 3-month competition inviting developers and founders to design and deploy scalable Web3 and RWA products on MANTLE's modular Ethereum L2, built for high performance, low fees, and full EVM compatibility. With $150,000 in prizes and a $30,000 grand prize, now is the time to build. Register by December 31st, 2025. Submissions are due by January 15th, 2026. To learn more, go to mantle.to/hackathon/U4U, and don't forget to follow mantle_official on X.
Katana is an opinionated blockchain. Its opinion is that for DeFi adoption, there are 2 key things we need: deep liquidity and high yield.
To learn more, go to katana.network. DECIBEL is the new sound of trading, a fully on-chain trading engine supporting spot markets, perps, and yield to trade global markets. Enjoy trustless execution and sub-penny transaction fees. Join the future of trading at decibel.trade and access the Decibel testnet today.
So there's quite high leverage on the platform. I want to speak just quickly to the stock side because we have a pretty unique implementation that I think users will find interesting. The constraint to date on offering high leverage from like a mechanism design perspective has been that most of the big moves for stocks happen overnight, like around earnings. So if you have very high leverage, you could easily run like a pretty simple delta neutral strategy where you go long on one side, you go short, you go long and short with high enough leverage. The stock moves a ton. You might get liquidated on one side, but you can't obviously get to like a negative balance and you'll make money on the other side. So the reason why we or others have been constrained on offering higher leverage on stocks is precisely because of this like market dynamic. And the way that we found to be able to sort of solve for that problem is by what we call somewhat cheekily the 0 DTE perp, which sounds oxymoronic. Does it expire or is it perpetual? And the answer is kind of Schrodinger's perp. It's both perpetual and expiring, depending when you open the box what the leverage level is. And by that I mean during market hours you can open at up to 100, like a 1% margin requirement. But your position, and this is clearly detailed in the UI, there's sort of a countdown timer showing you, it pops up in yellow, there's a countdown timer showing you like when your position will be closed. It will be auto-closed 15 minutes before market close. So you can't hold a high leverage position overnight. If you want to keep your position overnight though, you don't have to open a new position. You can take your existing position, and if you top it up to reduce your leverage dramatically to a much lower level, below the 10x threshold or below the 5x threshold, depending on the asset and sort of like the implied vol on that asset, then you can keep your position overnight. So a single position can be both perpetual or expiring, depending on what the risk is on that position. If the position risk is really high, it will get auto closed, and that's very clearly detailed and sort of like outlined. If your position risk is low, then you can keep it indefinitely for as long as you'd like. So we have this very unique mechanism to go and support these sort of, levels, like margin requirement levels that are unique in the space, especially for certain of the assets. And we've extended those like primarily to equities to date, but in theory can be extended to other asset classes as well.
So Cal, one of the constraints I've seen with a few other players getting into this, like, trading equities on chain, is liquidity is obviously very important, especially if you create positions with high leverage. So just curious how you're tackling kind of the liquidity constraint or the liquidity problem on your end.
Yeah, so I love this question because it gets really to the heart of what we're doing differently and what's unique about our approach, and I think is often misunderstood in the market. So most of the players out there that are now sort of entering the market, and I think not to pat ourselves in the back too much, but like I think we've been very, very right about the broader thesis, and we've been beating the drum on this for like almost 4 years at this point about just the market demand that will arise for trading traditional markets on chain through a perp or sort of like a perp-like instrument. That has now very much proven to be correct. There's been massive growth in demand. It's been, I think, the biggest story, sort of like the hottest trend of the quarter. And I think it will only continue to accelerate going into 2026. And so you see new market participants entering, seeing this opportunity, which is great. More competition is great. It's a sign the market is big. But everyone else that we see is taking an approach of trying to compete at the exchange layer. And what I mean by that is they are spinning up their own order books and having to populate those order books with makers on perpetuals for those new assets. And there are a few, problem is the wrong word, but hurdles that any exchange trying to introduce perpetuals on chain natively and recreate that order book liquidity natively is going to face and has faced, and I think ultimately have constrained the liquidity available on their products, especially at large size, which is you're basically competing. If you're trying to build an order book perp on, let's say, like Tesla, you are competing with the underlying exchanges. You are competing with the most liquid markets in the world. And I generally am of the belief that that is probably not the optimal strategy, especially like early days. It's going to be tough to get even close, even within 3 orders of magnitude of the level of liquidity you would find on the underlying exchange. It's one thing, for instance, for an on-chain order book to try to compete with a Binance, and that had proven impossible until very recently. Now you see liquidity that's starting to match like centralized exchange liquidity. But I think often people in crypto fail to recognize like the delta between the levels of liquidity, even on an asset like, a very liquid asset, like ETH or Solana, vis-a-vis the underlying markets, like vis-a-vis the liquidity, let's say, on like S&P futures on ES. Orders of magnitude higher. And while, we've come to the point where like you can start to compete with like Binance level liquidity, we're very, very far from being able to compete with like underlying exchange liquidity on the most liquid assets in the world. And even more importantly, the liquidity in those markets is even more highly concentrated than it is in crypto. You have, Binance, you have OKX, you have Bybit, you have, BitGet, whatever. You have these different exchanges that it is an oligopoly, but it's like not a monopoly. Whereas if you look in the US, for instance, you have like, they cover, slightly different markets. There's some points of more competition, but like CME and ICE have basically been on like M&A sprees for like the last 20 years, just acquiring other smaller exchanges. They're all aggregated at basically those 2 exchanges. There's other ones like there's like the LME for metals in the UK. There's a couple other ones, but it's highly concentrated. And so as a result, you're like trying to compete with sort of these like large players in TradFi that have aggregated all this liquidity. And I think while it sounds very good, the downstream impact on the user experience is actually quite a negative one, in the sense that like you might be able to quote tightly at the top of the book, but if you want to move any kind of size, you simply can't. Either you're going to get totally clobbered, like blowing through the entire order book, or, even if you like TWAP in very, very slowly over a long period of time, if you're massively skewing the book, you're going to get totally killed on funding. You're going to have these like massive fluctuations in funding rates. And the problem is that it makes it it optimizes. It's like a fun market for like an arbitrager to play in, assuming the kind of like rules of the game don't change all the time. But it is not an optimal place if you are a trader and you want to move size and you want to hold a position over some period of time. The odds that you wind up either getting totally, clobbered trying to enter your position or exit your position, simply because like your size is just going to go blow through the entire order book, or even if you make it in and out somewhat efficiently by like doing that over a long period of time, you're going to get hit with highly volatile funding. Funding might flip dramatically, for the weekend or whatever it is. It might go totally crazy when you enter because you're a large part of that market, large percentage of that market. It is not a good experience right now if you're moving any kind of size or you want to hold positions for any period of time. If you're like really scalping like in and out in tiny size, okay. But I don't actually think that's like the most interesting market to build for. And so as a result, we've opted for a very different architecture, and we're competing actually at a very different level. And this goes back to the core sort of thesis around the market that we're trying to disrupt, which I was articulating at the beginning. This market that we think the protocol can and will disrupt, we think DeFi, generally like writ large, will disrupt the offshore broker market because it's one of the most legacy, antiquated, and frankly, like predatory corners of traditional finance. I always say I think DeFi is going to eat the worst parts of TradFi first. And this is definitely one of the worst parts of TradFi. And so those different platforms are competing. They're operating, they're not exchanges, right? And I'll just give an example, right? Like if, you're a trader in the Philippines, if you want to trade Tesla, you're not going to go, someone's not going to go and create an exchange in the Philippines for Tesla stock. That makes no sense. There's going to be a broker that's going to figure out how to pipe in through some set of intermediaries to the underlying market and offer the price plus the premium of that market, the price of that market, plus some premium on top of it. And so all of these different platforms that are currently the primary gateway to the traditional markets for most people around the world are competing at the broker layer effectively. And I think where DeFi, where you can build this, I think the most interesting opportunity for sort of perps on these assets is not in trying to compete at the exchange layer. I think that's a very tough battle to win. And that will be, you would have to unseat a sort of monopoly or be competitive there. And I also think the competitive headwinds or the headwinds that you'll face from the existing players is going to be very tough. What I think is a much more interesting market and actually a much larger market is competing and trying to disrupt, building out crypto native infrastructure to disrupt the network of fragmented brokers that exist at the broker layer. And instead, doing that by piping in prices using a request for quote model to pipe in prices from the liquid underlying markets, rather than trying to recreate and repopulate your own native order books for all of those assets themselves. So the way that Ostium works today is if you want to open a position on gold, for instance, there's a request for a quote that's sent to our system. We fetch a price through a custom oracle that we built out in collaboration with Stork, which runs the aggregator, that produces a price that is sort of the very closest thing you could possibly get to the bid or the ask from the underlying market. And then that request for quote is sent, the quote is picked up, and then the trader is executed either at the bid or the ask from that quote, basically giving them access to something that's very close to the underlying market's liquidity, rather than them having to deal with the liquidity of the crypto native recreation of this market. Because the result is and you've seen this many times with some of the crazy wicks on many of these charts, which I'm sure you guys have seen for the new order book market for Tesla or for gold or whatever it is. You as a trader think you're trading gold, which is a $30 trillion market, subject to the liquidity dynamics of gold. And instead, you're trading in a liquid derivative on top of gold on a highly nascent order book. And so the liquidity on what you think you're trading gold actually dries up in tandem with all the crypto liquidity cycles. On 1010, it wicked down 25% on most of the major exchanges, except for on us, because we're not trying to recreate a native order book exchange for it. We're piping in pricing through a quote model from the underlying. So it's a completely different model. We're competing at a different layer of the stack, and we actually think it's a much bigger opportunity.
Okay, so given all the improvements you've made with this model, what's the feedback you're getting from these legacy offshore traders? And also would love to know more about how do you continue to onboard new users? As a DeFi investor, I turn to Maple for permissionless institutional quality yield in a single liquid asset backed by over-collateralized loans. Maple's SYRUPUSDC and SYRUPUSDT are now supported as collateral for enhanced yields on major DeFi liquidity hubs such as Pendle, Fluid, Camino, Jupiter, Morpho, and Aave. To learn more about Maple, go to maple.finance. River is building a chain abstraction stablecoin system that connects assets, liquidity, and yield across multiple chains. Season 3 is live. Earn River points by using SAT-USD in DeFi such as Pendle, PancakeSwap, and Uniswap. Stake River points to accumulate more or convert points to River tokens whenever you like. To learn more, go to river.inc. Hey folks, I want to tell you about our sponsor GEARBOX, the protocol that reimagines on-chain lending. With GEARBOX, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about GEARBOX, go to gearbox.fi. Puffer Institutional delivers secure, high-yield Ethereum staking built for institutions. With battle-tested security, granular access controls, and the ability to boost APY by securing multiple AVSs, Puffer gives institutions full control and optimized returns. Puffer is also behind the Unify-based rollup, aiming to transform Ethereum's future in a world where all L2s are working together. To learn more, go to institutional.puffer.fi.
So there's going to be a massive tailwind effect from existing crypto users who want to trade this stuff. And so I think you can 5x, I think, from where we are, 5 to maybe 10x just within just from the tailwinds of the growth within the crypto market of demand for this stuff, and continuing to push into that. But the 100x opportunity comes from being able to penetrate that broader traditional market. And I think, some of the most, just maybe go back to what is wrong with these, or what is lacking currently in these existing platforms. I mentioned this earlier, things that crypto people expect as table stakes are actually really novel for this audience. An example, and this is sort of where the competitive advantage comes in, and this is how you get to these users. I think it's twofold. One is, it's actually one main point with a subpoint. The main point is you have levels as a user. If you shift from a centralized broker to an on-chain protocol like Ostium, you move from having no idea what's going on in the system and what any other trader is doing, and frankly also no idea how much liquidity is available to you, to a world where you can see precisely what the price impact or the spread on your trade is going to be before you execute it, to where you can see what everybody else on the platform is doing, what all of the exposures are of the pool, where you can see everything that's going on. And that is not also where you can track your own portfolio. You can see, you verify it on chain, how much money you've made or lost, how much volume you've done. And that sounds pretty table stakes to a crypto user, but it's really not for people coming from these traditional brokers. It sounds almost impossible to believe, but on many of them, you actually can't see how much volume cumulatively you've done. You can't see your total cumulative P&L over time. These things are hidden. You can't see how much you've ever paid in fees. You can't find this information. They don't reveal it to you. You have to email them to get them to produce a special CSV to give you this information. That's insane. You also can't see what anybody else is doing. There's no leaderboard for you to track and see, follow this trader, see what they're doing, take a look at their strategy, see what assets are trending that day. Some of them might show you some asset trends, or they'll show you a little thing that shows you what percentage of people are long or short that asset. But that's about it. You can't go anything more granular than that. And most of these stats are completely obfuscated. And so the real value add and sort of the unique positioning here is actually basically fundamentally selling blockchain. All this stuff is a fundamental use case for crypto. It's I think it's the most textbook use case I've ever seen for crypto, frankly, for a traditional market product, is you get all of these benefits of self-custody, of transparency, of being able to see what other people are doing, verifiability, and you get that in a very concrete way, even just like literally through the user interface, in the sense that you have a portfolio we can like directly page where you can like directly track like, you know, your volumes and your P&L and all that stuff. Hopefully that answers your question.
So you recently announced a $20 million Series A, I believe, for Ostium. When I see stuff like that, I'm curious, you as the founder, what does this open up or enable you to do that you couldn't before? Like where is this money going to be most usefully deployed to grow Ostium?
Yeah, it's a great question. And I actually think like a question people should get more often, because I think in the very like early days of a startup, you can be in like sort of like survival, getting to the next milestone point. And then you hit this inflection point. It's a little bit what we talked about earlier in the pod about like about like, you know, the ramen startup environment, like in the trenches, to like cultivating environment for other people to succeed. That you hit this inflection point after you raise a Series A where you really have to kind of go back to first principles, but like you have this money. What are you going to do with it now? Like, what is the single best use of this capital? You're no longer like struggling for cash. We are very lucky to have great protocol economics. Like we are cash flow positive. So it's really, it's around about like growth. And it's around to enable us to like reach this next inflection point of hockey stick growth. And so a couple things to answer the question more specifically. One is scaling the liquidity. This is the single most important thing with our model, is allowing us to expand the capital efficiency of the model and offer billions of dollars in open interest and volume. And that will be made possible through new liquidity partnerships that will enable us to expand from what is currently a single quote model. So to date, we have this oracle that goes and produces fetches prices for the underlying market, produces a single quote. Whenever there's a request for a trade, there's a request for a quote, that quote is passed on. That has worked to date. But where this model is going to evolve over time, and I alluded to this a little bit in the fundraise announcement, is towards a competitive quote model, because that's ultimately what's going to allow us to have a system that can clear billions of dollars in flow and can price very, very, very large positions. Right now, we have the best pricing for large positions, but we're constrained somewhat by the open interest caps that we can provide. If we want to be able to clear, you know, billions of dollars in volume and you know, trades that are getting into the, you know, dozens or hundreds of millions in size, there needs to be a system to allow for competitive quoting rather than just having this sort of like single quote. So these new partners that we're bringing on the table will be critical, and we're building towards that infrastructure right now. You'll hear more about it in early Q1, but are allowing us to build towards a sort of more competitive quoting model that allow us to massively expand the liquidity. And then secondly is, and actually I hate to say secondly because it's actually the single most important thing for a company, period, is hiring exceptional people. This goes back to what I was saying before about this transition from like, you know, your success in the early days when you're like two people living in a hacker house, the success being primarily about like what you do in the trenches, to this transition point where your success as a company is largely defined by the caliber of the people that you bring around the table to work on a really interesting problem. And we've like, I think, chronically underhired to date, and we are making a push to bring on, being an extremely high bar, but bringing on truly exceptional people across every level of the stack, from, you know, back-end engineering and smart contracts to sort of like sales and BD, to sort of like marketing and growth. And rather than hiring for sort of like these very specific roles and overly determining them, we're really just looking for exceptional people. And I term this as kind of like spiky people in sort of like the letter from the founders that we shared. We're looking for really exceptionally interesting and smart and spiky people who excel in a vertical, maybe one that you wouldn't even think about. You know, I thought about maybe hiring like kind of like a creative or like branding director. Maybe we like wouldn't think that we would need that, but I'm open to. My vision is really to bring truly spiky and exceptional people around the table to help us build the future of this company. And frankly, obviously, you know, talking our book here, but Ostium is genuinely one of the most interesting applications of crypto, period. I think if you want to work in crypto, so many people are jaded because there's been, I think, so many eras of, you know, uninteresting problems or problems that were worth working on. disrupting a legacy antiquated industry whose every single problem, from like account freezes to lack of transparency to, you know, full custody, is a textbook use case for blockchain, is genuinely, I think, one of the most interesting problems to work on in crypto. And if you want to be in the space, you should come work for us. So that's what we're using the money for.
I just want to call out that as we're recording this, Ostium is averaging, let's say, around 100 million in daily volume. I was looking at open interest around 150 million. I have no doubt those numbers will get blown out much higher in 2026. And we will have to have you back, just given this evolution into the competitive quoting model. So just love to see founders working on big problems, not, you know, creating the next Sonic the Hedgehog, Mickey Mouse, you know, meme coin. So anyways, we love what you guys are building, and we'd love to have you back in the future. That all said, I want to remind our audience that they can learn more about Ostium by going to ostium.com. They should follow Ostium Labs on X or Twitter, and then follow Kaledora, just one word. We'll put that all into the show notes so you can easily find it. Cal, thank you so much for coming on with us, and you know, I want to give you the final word before we go.
Thank you guys for having me on. It's been a pleasure. It's very fun. And final word is try the product, give us feedback. And if you want to work with a very cool team, join our team.
Thanks everyone for tuning in. To stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.